Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market.
I'm quite interested right now to hear your thoughts on the market reaction. Right after the FOMC, Treasuries sold off on the front end with the 2-year rising much more sharply than the 10-year. What's your take on this? Does that suggest markets believe the Fed will keep policy tight and defend its inflation objective if necessary, or is it pointing to something less reassuring about the growth outlook?
Well, I think get back to what I said about how we were viewing where the Fed was before the Walsh meeting. The market was kind of pricing in a very tentative hike ahead. We weren't really convinced by it, but there was sort of some mild tightening priced in before the meeting. That really firmed up in the 24 hours after the meeting. So I think what we're looking at is kind of classic bear flattening, right? The market thinking that the rates are going to go up in the short term. And so that has a bigger influence on the 2-year outlook than it obviously does on the 10-year outlook. And I think that was the major response that we saw. But of course, since then, it's the oil price has come down even further than it was on the Wednesday of the meeting. The rise in oil prices, really did have quite a big impact on inflation expectations in the bond market, even at the 10-year horizon. And so that's been something that I think has been holding down the 10-year. But the other thing that I think is worth mentioning is that it has kind of added to that angst out there in the market about the richness of equity valuations. There's been nervousness for some time about how elevated equity markets have got, and I think these more hawkish noises coming out of the Fed have kind of added to that.
Thinking of treasuries more broadly and maybe more on the long term, do you think the arrival of the new Fed chair and the prospect of this policy change we've been discussing, does it alter the underlying direction of yields, notably as the Treasury curve is under pressure, the facing upward forces from rising supply?
I think it kind of cements a trend that we've been seeing anyway. I think over the last 2 or 3 years, it's become clear that the market's getting more concerned about supply as the US fiscal deficit remains very large. And obviously, up until quite recently, the Fed was shrinking their balance sheet. And of course, one of the quite interesting developments in the Treasury market in recent years has been the increasing share of hedge funds as holders of treasuries. And obviously they're more price sensitive investors, whereas previously you had foreign exchange reserve managers in other countries, kind of fairly passive holders of treasuries and of course the Fed. And I think that's where this balance sheet approach that Walsh appears to be taking very seriously, this idea that the Fed should run a smaller balance sheet. I think that's pretty significant, because if the Fed's not holding as much, then because it's running a smaller balance sheet, then the market's got to hold more. So, I think one way in which this has manifested itself has been the rise in the term premium. For almost a decade after the GFC, we had a negative or zero term premium. So the difference between the 10-year yield and the market's expectations of policy rates over a 10-year horizon, that was very, very low or negative. That's moved up into sort of 50 to 70 basis points territory. And I think if the Fed is serious, it's going to take a serious look at its balance sheet policy. I think that's going to keep upward pressure on the term premium. That's going to keep the 10-year elevated.
Finally, Brian, as the rating agency, we need to think about the implications of the new Fed or this reset of the Fed for credit. If the more hawkish dots prove right and rates are directionally higher for longer, where do you see the biggest impact across credit markets?
I mean, we're not talking nobody's really talking about big increases in policy rates, 200 basis points, anything like that. So, it's kind of at the margin. So hopefully it's not a big shock for the credit market, but obviously it's the more leveraged borrowers, I guess, the sub-investment grade versus investment grade on the corporate side. But more broadly, look at, where has the debt and the debt ratio has gone up in the last 5-10 years. It's really big governments, right? That's and developed country governments, including the US. And the US does have quite a high exposure to short-term rates in terms of public debt service. And obviously, the other key area is the housing market, which is the increase in the 30-year yields that we've seen recently. That's really weighing on the housing sector, and that's not going to turn around if we get higher policy rates.
Thanks, Brian. That was Brian Coulton, our chief economist, on the new Fed chair, the policy shift and what it could mean for rates, markets, and credit. As you heard, more to come on the topic. Thanks for listening.
Subscribe to Fixed Interests wherever you get your podcasts.